That is when SpaceX is set to go public in what will almost certainly be the largest IPO in the history of the stock market. Not just the largest in recent memory. The largest ever. A company targeting a valuation of approximately $1.75 to $2 trillion that will immediately rank among the most valuable companies on Earth the moment it begins trading, more valuable than every company currently in the S&P 500 except a handful of the very largest names. And here is what most investors have not fully thought through yet. If you own VOO, if you own QQQM, if you own a target date fund in your 401k, if you own virtually any broad market index fund, you are about to be forced to buy SpaceX. Not by choice. Not because you researched it and decided it was fairly valued. But because the index your fund tracks will be legally required to include it, and your fund will be legally required to buy it, at whatever price the market sets at that moment. That process, the mechanics of how a nearly $2 trillion company gets absorbed into indexes that were never designed to handle an IPO of this scale, is one of the most consequential and least understood investment stories of 2026. And today on Dividend Desk, we are going to break down exactly what is happening, what the three phases of this event look like, what the real risks are for passive investors, and specifically what you can do about it. Let's get into it. Before we dive in, if you are not yet subscribed to Dividend Desk, hit that subscribe button right now. We cover investing, ETFs, market analysis, and portfolio strategy every single week. Hit like if this video adds value. Now let's go. Disclaimer: nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely for educational and informational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. Before we get into mechanics and strategy, let us establish the scale of what we are talking about, because the numbers are genuinely extraordinary and easy to underestimate when you hear them in the abstract. SpaceX is going public at an expected valuation of approximately $1.75 trillion, with some estimates pushing toward $2 trillion depending on market conditions at IPO. The company plans to offer approximately $75 billion worth of shares to the public, which sounds like an enormous number until you realize it represents a float of just 4.3% of the total company. 4.3%. That means the overwhelming majority of SpaceX shares, roughly 95.7%, will not be available for purchase by the public at IPO. They will be held by Elon Musk, who owns approximately 42% of the company. By employees with restricted stock units and options, representing another 10 to 15%. By major institutional holders including Alphabet at 6.1%, Fidelity at 2.3%, Founders Fund, Sequoia, and sovereign wealth funds each holding meaningful stakes. All of those shares are locked up. The holders cannot sell during the initial lockup period following the IPO, which typically runs somewhere between 90 and 180 days depending on the terms negotiated with the underwriting banks. Some stakeholders may face even longer restrictions. So on day one of SpaceX's public trading life, you have approximately $75 billion of shares available for the entire world to buy against what is expected to be an extraordinary wave of institutional and retail demand from investors who have been waiting years to get access to this company. Now let us layer in the index mechanics, because this is where the situation becomes genuinely complicated. The SpaceX IPO is not a single event. It is a sequence of events that will play out over months, and each phase has different implications for different types of investors. Phase 1 is the IPO frenzy. This begins the moment SpaceX shares start trading on June 12 and likely extends through the first several weeks of public trading. Retail demand for SpaceX has been building for years. There is no other company on Earth with this combination of brand recognition, technological achievement, Elon Musk association, and the specific narrative of being the company that is commercializing space, building the largest satellite internet network in history, and working toward the eventual colonization of Mars. When that company becomes available to buy for the first time, the emotional and speculative demand from retail investors is going to be enormous. At the same time, institutional demand from active managers, hedge funds, and thematic ETFs that want SpaceX exposure will be competing for the same limited supply of shares. With only 4.3% of the company in the float, the fundamental supply-demand math is stark. Enormous demand chasing a tiny available supply almost always produces one outcome, a sharp, rapid price increase that may bear little relationship to fundamental valuation. Phase 2 is forced index inclusion, and this is the phase that affects you most directly if you own passive index funds. The NASDAQ has already changed its rules specifically to allow large IPOs to be fast-tracked into the NASDAQ 100. Under the new rules, a company that IPOs within the top 40 market cap on the NASDAQ will be included in the index within 15 days of trading. And because SpaceX's float at 4.3% is below the 33% threshold in the NASDAQ's formula, the index applies a 3x multiplier to the float-adjusted weighting. Working through that math, SpaceX would initially receive approximately an 89 basis point allocation in the NASDAQ 100, just under 0.9% of the index. That number sounds modest. But the NASDAQ 100 has approximately $500 billion in assets tracking it across ETFs, mutual funds, and institutional mandates. An 89 basis point allocation across $500 billion means approximately $4.5 billion in forced buying by NASDAQ tracking funds within 15 days of the IPO, buying that must happen regardless of what the price is at the time of inclusion. The S&P 500 picture is even larger in scale but more uncertain in timing. The S&P 500 has approximately $24 trillion in assets tracking at a number so large it makes the NASDAQ's $500 billion look small. The S&P 500 is proposing rule changes similar to what the NASDAQ already approved, but the S&P 500 has a human committee that makes inclusion decisions rather than a purely mechanical rules-based process. They also require 4 consecutive quarters of profitability before adding a company, a standard that SpaceX likely meets but that OpenAI and Anthropic probably do not. If SpaceX ultimately gets a 3.5% weight in the S&P 500, which is what comparable companies at similar valuations suggest, the forced buying from S&P 500 trackers would be approximately $840 billion. Add the NASDAQ buying and you are approaching $860 billion of total forced institutional buying of a company with a $75 billion initial float. That math does not work. It cannot work without spiking the price dramatically. And that spike feeds back into the weighting calculation. If the price doubles, the required purchase amount doubles too, creating a feedback loop that has no natural stopping point other than the eventual arrival of Phase 3. Phase 3 is lockup expiration. This is when the story reverses. 6 months after the IPO, the earliest lockup agreements begin expiring. The venture capital funds that invested in SpaceX at valuations of $1 billion or $5 billion or $50 billion, investors who are sitting on 30, 40, or 50 times their money can finally sell. The employees with stock options worth millions of dollars can finally lock in their gains. Elon Musk himself, depending on his specific lockup terms, may be able to begin selling. The supply of SpaceX shares available to the market goes from 4.3% of the company to potentially 30%, 40%, or more as insiders sell into the market. The same supply-demand dynamic that drove the price up in phases 1 and 2 now works in reverse. A massive increase in available supply against demand that has already been partially satisfied by the early buyers causes prices to normalize, and normalization from a dramatically inflated IPO price can look a lot like a crash. Let us be direct about the risk this creates for ordinary investors in passive index funds. If you own VOO, QQQM, VTI, SPY, or virtually any broad market index fund, you are going to own SpaceX. You do not get to vote on this. The index your fund tracks will include SpaceX, and your fund is legally required to match that index. The price at which your fund buys SpaceX is whatever the market price happens to be when the fund executes its purchase. There is no ability to wait for a more reasonable valuation, no flexibility to say the stock looks overpriced, no judgment call available to the fund manager. Imagine SpaceX opens for trading and the price surges 200% in the first week on the combination of retail frenzy and early institutional buying. The NASDAQ 100 fund is required to buy at those inflated prices 15 days after the IPO. The S&P 500 committee, watching the price spike, faces pressure to include SpaceX quickly or risk being seen as falling behind. They buy at elevated prices. Every dollar of passive capital flowing into these index funds through 401k contributions and retirement savings is now buying SpaceX at whatever the frenzied market price happens to be. 6 months later, when the lockup expires and hundreds of billions of dollars of insider holdings flood the market, the price corrects to something closer to fundamental value. Your index fund, which was forced to buy at the peak, has now absorbed that loss. And because SpaceX would represent a meaningful percentage of these indexes at its peak valuation, even a significant correction in SpaceX's price translates to a real and noticeable impact on your overall index fund return. The scenario where SpaceX temporarily reaches a $6 trillion or $10 trillion valuation during the frenzy, numbers that sound absurd but are not mathematically impossible given the supply-demand dynamics, before crashing back to a $2 trillion fundamental valuation, means index funds could lose 4 to 8 percentage points purely from the SpaceX inclusion event. For someone with $1 million in index funds approaching retirement, that is $40,000 to $80,000 in losses driven not by the economy, not by earnings, not by any fundamental development, but by mechanical index rebalancing at the wrong price. There is also the selling side of the equation that rarely gets discussed. When index funds need to buy $860 billion of SpaceX, they need to raise that capital by selling other holdings proportionally. Every other stock in the S&P 500 and NASDAQ 100 faces selling pressure as index funds trim existing positions to make room for SpaceX. The stocks getting sold are not underperforming, they are simply the things that need to be sold to fund the mechanical purchase of SpaceX at whatever price the market sets. One of the more interesting strategic questions around the SpaceX IPO is whether the NASDAQ 100 or the S&P 500 is better positioned to navigate the inclusion. The NASDAQ has moved faster on rule changes and will include SpaceX within 15 days. This gives NASDAQ tracking funds earlier access at what may be lower prices than the S&P 500 will eventually pay if the price continues rising after the initial 15-day inclusion. The NASDAQ is also a smaller index in asset terms, meaning the $4.5 billion or so of NASDAQ required buying is more manageable than the potential $840 billion from S&P 500 trackers. However, the NASDAQ's faster inclusion also means it is buying during the period of maximum uncertainty and potentially maximum speculative frenzy. Buying within 15 days of the IPO means buying while retail momentum is at its peak, before any meaningful fundamental data about the public company is available, and before the initial excitement has had any chance to normalize. The S&P 500, with its committee-based inclusion process and profitability requirements, has historically moved more slowly on major IPOs. With Tesla, the committee delayed inclusion for years while the stock ran up dramatically. That delay cost S&P 500 investors the upside but also protected them from buying at the peak. The committee approach is genuinely slower and has its own costs, but it also provides a human judgment layer that mechanical rules-based indexes do not. For investors trying to decide between QQQM and VOO as their primary index exposure through this period, the honest answer is that neither is perfectly positioned. The NASDAQ buys earlier but smaller. The S&P 500 buys larger but later and potentially at different prices depending on how the committee decides to handle the inclusion. The S&P 500's diversification across 500 companies means SpaceX's impact on the overall fund, while significant, is diluted across a broader base than the concentrated 100-company NASDAQ 100. There is an ETF called IPO by Renaissance Capital that invests specifically in U.S. IPOs and holds those positions for 3 years before rotating out. If IPOs were systematically good investments, this fund should outperform the broad market. The data says otherwise. This ETF has been comprehensively beaten by VOO, QQQM, and essentially every major broad market index fund over meaningful time periods. The reason is structural. Companies choose when to go public. They choose to go public when they and their investment bank advisors believe the valuation is at or above fair value. They are IPOing at a price that maximizes their fundraising and their existing shareholders' exit values. This means the public market buyer at IPO is, by definition, buying at a price that the best-informed investors in the company believe represents full or generous value. SpaceX presents this challenge in its most extreme form. The company is not going public at a startup valuation where there is enormous room for growth in the stock price. It is going public at approximately $2 trillion, already among the most valuable companies in the history of capitalism. Amazon did not IPO at $2 trillion. Google did not IPO at $2 trillion. Meta did not IPO at $2 trillion. They IPO'd at valuations of a few billion dollars and grew into enormous valuations over years and decades of compounding earnings. SpaceX is starting the public investor's journey at the destination those companies eventually reached, which mathematically limits how much further it can go relative to what was possible if you had invested at the beginning of the journey. This does not mean SpaceX cannot be a good long-term investment. The space economy thesis is real, the company's competitive position is extraordinary, and there is a credible path to significant further growth. But buying at $2 trillion is a fundamentally different proposition from buying Amazon at $400 million. The hypergrowth phase is largely over for the stock by the time the public can access it. So what should investors actually do with all of this information? Let us build a practical framework. If you own passive index funds as a long-term investor with a 10, 20, or 30-year horizon, the honest advice is largely to stay the course. The SpaceX IPO event may cause meaningful short-term volatility in your index funds, potentially a 4 to 8% swing in either direction depending on how the mechanics play out. But investors with genuinely long-time horizons who have survived 2008, 2020, and every other market disruption will almost certainly look back on this period as noise rather than a defining event for their long-term returns. Dollar-cost averaging through the volatility is likely to serve long-term investors better than any attempt to time around the IPO mechanics. If you want pre-IPO SpaceX exposure today, the cleanest option is the NASA ETF by TEMA ETFs, which holds SpaceX through an SPV structure at approximately 10 to 15% of its portfolio alongside other pure-play space economy companies. We covered this fund in detail in a recent Dividend Desk video. Check the description for the link. This gives you SpaceX exposure now, before the IPO, in a fully liquid SEC-registered ETF structure. If you want to buy SpaceX at IPO directly, the most honest framework is to treat it as a short-term trade rather than a long-term buy and hold at IPO prices. The supply-demand dynamics in the first days and weeks of trading are likely to create momentum-driven price movement that may significantly exceed fundamental value. If you are trading around that momentum, size the position appropriately for a speculative trade, know your exit before you enter, and do not let a successful initial trade convince you that paying a $6 trillion valuation for a company earning its current revenues makes sense as a long-term hold. If you want to wait for a better entry point, the lockup expiration approximately 6 months post-IPO is the period when the structural dynamics are most likely to create a more rational price. When insiders can finally sell and supply floods the market, prices that were driven to extraordinary levels by forced institutional buying against a tiny float may correct meaningfully. Waiting for that normalization and buying at a more fundamental valuation has historically been a better risk-adjusted approach than buying into IPO frenzy. And if you simply want to avoid SpaceX exposure entirely while maintaining market exposure, dividend-focused ETFs with high-quality, established companies that are unlikely to have significant SpaceX weighting, your VYMs, your SCHDs, your dividend growth funds provide a way to stay invested in the equity market while limiting your mechanical exposure to the IPO mechanics playing out in the broad indexes. The SpaceX IPO on June 12 is a historic event by any measure. The largest IPO in history. A company that has genuinely transformed the economics of space. A set of index mechanics that have never been tested at anything close to this scale. And a situation where ordinary passive investors are going to be exposed to extraordinary volatility driven not by economic fundamentals but by the mechanical requirements of market cap-weighted index rebalancing. The 3 phases: IPO frenzy, forced index inclusion, and lockup expiration are the framework for understanding how this unfolds. The float problem is the fundamental driver of why the first 2 phases create more volatility than any comparable event in recent market history. And the long-term question of whether SpaceX can grow into its IPO valuation is ultimately what determines whether this was a generational opportunity or a cautionary tale about the dangers of forced institutional buying at any price. Understand the mechanics. Size your exposure appropriately. Know your time horizon. And do not confuse the excitement of the event with a clear-eyed assessment of the investment. At Dividend Desk, this is the kind of analysis we bring you every week, the honest, complete picture that helps you make smarter decisions with your money. If this breakdown was useful, please hit the like button and subscribe so you never miss a video. Join the Dividend Desk community. The link is in the description, where we track developments like this in real time. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.